The screens still glow green dot. Stock markets continue climbing. Delivery apps still function. Airports remain crowded. Somewhere inside a quiet apartment tower overlooking a modern city, a man pours coffee while casually checking his investment. Portfolio numbers flicker upward. Retirement accounts appear stable. His bank balance hasn't changed. Overnight, everything looks normal. And that is precisely what makes the moment dangerous. Because history has a strange habit of disguising. Collapse beneath the appearance of stability, civilizations rarely announce their breaking point dramatically. Financial systems do not usually fail with explosions, riots, or sirens echoing through the streets. The most dangerous collapses arrive quietly. Administrative, procedural, hidden beneath press conferences, policy changes, and reassuring headlines. At first, nothing feels different then, one morning, people realize their money still exists. But their freedom around it does not. A notification appears on a phone screen. Temporary withdrawal limits have been introduced to preserve market stability. Temporary, history's favorite word before permanence. The man refreshes the app. Again, his savings are technically still there. His salary still arrives every month. His digital wallet still works at grocery stores. Yet outside the invisible architecture of daily life, something fundamental has shifted. Inflation is accelerating faster than wages. Governments are quietly increasing surveillance over financial transactions. Banks are becoming more restrictive. Debt is rising faster than economies can realistically repay it. And ordinary people continue scrolling through social media as if systems built on confidence can never fracture. But history whispers a darker truth. Every major financial collapse initially looked manageable. Rome still appeared eternal, while emperors quietly diluted silver inside the currency. Citizens continued spending coins without realizing the empire was stealing purchasing power invisibly. The metal remained. The value disappeared. Centuries later, the same pattern repeated with more sophistication. In Argentina, citizens watched inflation consume savings, while officials insisted stabilization was near. In Lebanon, people stood outside banks begging for access to money, legally belonging to them. In Venezuela, middle-class professionals carried bags full of currency that could barely purchase basic food. The pattern never changes as much as societies believe. Only the technology changes. Ancient kingdoms confiscated wealth with soldiers. Modern systems confiscate wealth with software. And perhaps the most unsettling part is that most people will not recognize the transition. While it is happening because modern collapse does not begin with visible destruction, it begins with altered definitions. Ownership becomes access. Savings become permissions. Money becomes conditional. That transformation sounds abstract, until systems suddenly decide who can move wealth, where it can move, and how much remains accessible. For decades, modern civilization trained people to believe convenience equals freedom. Tap a card, scan a phone, transfer. Money instantly across continents. Everything frictionless, effortless, invisible. But convenience created dependence, and dependence created vulnerability. Most people no longer hold wealth in physical form. Their assets exist inside centralized systems connected to governments, regulators, banks, brokerages, pension funds, and digital networks they do not control. The numbers feel personal, but the infrastructure is not. That is the hidden paradox. At the center of modern finance, the more technologically advanced a system becomes, the easier it becomes to monitor, restrict, freeze, or manipulate wealth invisibly. A medieval ruler needed force to seize gold. A modern government may only need a policy update. Or inflation. Or emergency powers. Or digital compliance systems justified through public stability. And history shows something terrifying about populations under pressure. People accept extraordinary restrictions when fear becomes widespread enough. During crises, societies willingly trade autonomy for reassurance. Citizens comply because instability feels more frightening than control. Human psychology craves order, even if that order quietly erodes freedom itself, which is why financial collapse rarely feels cinematic at first. It feels bureaucratic. A form requiring verification, a delayed transfer, a restricted withdrawal, a frozen account, a policy temporarily limiting movement of capital. Civilization does not collapse. Like a bomb exploding dot, it collapses like oxygen, slowly leaving a sealed room, while everyone continues speaking normally. And perhaps the greatest illusion modern societies ever created is convincing ordinary people that numbers on screens represent permanent ownership. But ownership has always depended on political stability, and political stability depends on confidence. Once confidence begins cracking, governments face a terrifying dilemma. They must prevent panic, because panic spreads faster than economic recovery. And when fear spreads through financial systems, money behaves like water, escaping a sinking ship. Citizens move savings. Investors flee currencies. Wealth searches for safety. Governments understand this deeply, which is why collapsing systems almost always target the movement of capital itself. Not necessarily because leaders are evil, but because systems, under stress, become desperate. Systems prioritize survival above principle. This creates one of the darkest paradoxes in modern economics. The moment people need financial freedom most is often the exact moment systems begin restricting it. But hidden inside history is another pattern most people overlook. Throughout every major collapse, a small minority consistently preserved wealth, mobility, and independence better than everyone else, not because they predicted exact events, not because they were lucky, but because they understood something ancient civilizations learned repeatedly through war, inflation, and political instability. Real wealth is not merely what you own, it is what you can still control when systems become unstable. That distinction changes everything, because during prosperity, society rewards visible wealth, expensive homes, luxury lifestyles, digital portfolios. Symbols of status deeply connected to stable systems. But collapse changes the rules completely. A mansion cannot cross borders, a frozen bank account cannot buy opportunity, a collapsing currency cannot preserve dignity. And suddenly, assets that once appeared boring become priceless. Skills, mobility, portable, stores of value, decentralized systems, trusted human relationships, things civilization often underestimates, until stability disappears, because when systems begin breaking, the world divides into two groups of people: those trapped inside collapsing structures, and those carrying assets, capable of escaping them. And history suggests something deeply uncomfortable. When governments become desperate, they do not hunt what people value most, they hunt what people cannot move, which raises the question modern civilization may soon be forced to confront when financial systems begin closing. What actually survives? History rarely announces itself. While it is happening, empires collapse quietly at first. Financial systems decay invisibly long before ordinary people recognize danger. And perhaps the strangest part of human civilization is this: every generation believes its institutions are more permanent than the generations before it. Rome believed its empire would last forever. So did the Soviets. So did the citizens of Weimar. Germany, before wheelbarrows of currency became necessary to buy bread. Confidence has always been civilization's favorite illusion. And when that illusion begins cracking, governments throughout history respond in remarkably similar ways, because history repeats perfectly. But because power behaves predictably under pressure, ancient Rome offers one of the clearest examples. As military expansion slowed and state expenses exploded, emperors faced a problem modern governments still struggle with today. Promises had become larger than resources. The empire needed money it no longer truly possessed. So leaders chose a quieter solution. They reduced the silver content inside Roman coins while keeping the appearance unchanged. Citizens still saw familiar currency. Markets continued functioning. Daily life appeared stable on the surface, but invisible confiscation had already begun. Each coin contained less real value than before. The empire was stealing purchasing power from its own population without physically seizing wealth. And that reveals one of history's darkest financial truths. Governments do not always confiscate wealth directly. Sometimes they simply dilute reality itself. Centuries later, civilizations became technologically advanced, politically sophisticated, and economically interconnected. Human psychology did not change at all. In 1933, during the Great Depression, the United States government issued Executive Order 6102 under President Franklin Roosevelt, Citizens were ordered to surrender privately owned gold in exchange for paper currency. Possessing significant quantities of gold became illegal. Imagine the psychological shock. People who believed they truly owned their savings suddenly discovered ownership could be redefined by emergency decree, and yet most citizens complied. Fear changes human behavior faster than ideology ever can. The government justified the action as necessary to stabilize the economy, and perhaps that is what makes financial control so psychologically powerful throughout history. Restrictions rarely arrive wearing the face of tyranny. They arrive wearing the language of protection. Temporary measures, emergency. Stabilization, public necessity, national security. The wording changes, the mechanism remains astonishingly consistent. Because when systems begin weakening, governments become trapped between preserving freedom and preserving order. And throughout history, order almost always wins. Argentina revealed this repeatedly over decades. Inflation accelerated while citizens desperately converted savings into US dollars to preserve purchasing power. In response, governments imposed restrictions on foreign currency access. Official exchange rates diverged wildly from black market reality. On paper, the system remained functional. In reality, trust had already collapsed, and trust is the invisible oxygen of every financial system ever created. Without belief, currency becomes paper. Banks become buildings, markets become theater. That is why collapse spreads psychologically before it spreads economically. People sense instability emotionally long before statistics fully reveal it. In Greece, during the 2015 debt crisis, citizens lined up outside ATMs after withdrawal limits were imposed. Elderly pensioners stood beneath the Mediterranean sun, waiting for permission to access their own savings. Their money technically still existed, but accessibility had vanished. That distinction matters more than most people realize, because wealth inside a collapsing system often transforms into a strange illusion, visible but unreachable. Numbers remain on screens, while freedom around those numbers quietly disappears. Lebanon became another haunting example. Banks froze withdrawals, while ordinary citizens watched life savings become trapped inside institutions that once symbolized security. Families who spent decades building financial stability suddenly found themselves negotiating for access to basic funds. Some depositors reportedly begged bankers for medical money. Others simply stared in disbelief, because modern people are psychologically conditioned to trust systems until the exact moment systems stop functioning. And perhaps no example illustrates the brutality of invisible confiscation better than hyperinflation. In Zimbabwe, inflation accelerated so aggressively that prices doubled faster than workers could spend wages. Currency lost meaning almost in real time. Teachers, doctors, and professionals carried stacks of banknotes large enough to fill backpacks, only to discover those notes could barely purchase groceries by evening. The money still existed physically. Its value evaporated psychologically, and Venezuela exposed something even deeper about collapse. Financial destruction does not initially erase civilization. It erases predictability. One day, middle-class professionals planned vacations and retirement accounts. Months later, those same people searched for food, medicine, and survival strategies. Engineers drove taxis. Teachers traded possessions for essentials. Entire social hierarchies inverted under economic pressure. The terrifying part is how gradual the transition felt. While it unfolded, people adapted step by step. Inflation became normal. Shortages became manageable. Restrictions became understandable. Temporary measures became permanent. Reality, human beings possess an extraordinary ability to normalize deterioration when deterioration arrives slowly enough that may be civilization's greatest. Psychological vulnerability, because collapse rarely feels catastrophic in the beginning. It feels inconvenient, then stressful, then exhausting, then irreversible. One hidden pattern consistently emerges. Governments rarely seize wealth because they are confident. They seize wealth because they are losing control. Confiscation is not usually a sign of strength. It is often the final symptom of systems desperately attempting to survive themselves, which creates a disturbing paradox. Modern societies struggle to confront the institutions people trust most during prosperity. that often become most dangerous during instability. Banks need liquidity. Governments need compliance. Central banks need confidence. And once confidence fractures, extraordinary policies suddenly become possible. That is why history matters, not because the future repeats perfectly, but because human systems reveal recurring behaviors under stress. Debt expands beyond sustainability. Currencies weaken. Trust declines. Restrictions increase. Freedom narrows gradually in the name of stability, and eventually, societies discover a terrifying truth hidden beneath modern civilization itself. The line between financial management and financial control becomes dangerously thin during crisis, which raises an uncomfortable possibility. If every collapsing system throughout history developed mechanisms to restrict, inflate, freeze, or redefine wealth, then perhaps modern civilization already contains those same mechanisms, quietly waiting beneath the surface, hidden inside digital banking. Emergency powers. Monetary policy, capital controls, and the collective assumption that today's stability is somehow permanent, because history suggests something deeply unsettling. The most dangerous systems are not the ones openly collapsing. They are the ones still convincing everyone they cannot. Modern finance was designed to feel invisible. Tap a screen, move money instantly, pay bills without touching cash, invest globally from a phone while sitting in bed. Everything appears seamless, frictionless, almost magical. But invisible systems often become the most dangerous systems, precisely because nobody examines them closely. Beneath the polished surface of modern banking lies a hidden architecture of dependence, a structure so deeply integrated into everyday life that most people mistake access for ownership, and that illusion works perfectly until pressure enters the system. A man checks his banking app and sees $100,000 displayed on the screen. Psychologically, he believes he possesses $100,000. But legally and structurally, the reality is more complicated. Modern bank deposits are not piles of cash sitting untouched in vaults waiting patiently for retrieval. They are liabilities, promises, digital obligations, existing inside interconnected systems built entirely on confidence under normal conditions. The distinction feels irrelevant. During collapse, it becomes everything, because financial systems function like massive theaters of coordinated trust. As long as most people believe money remains accessible, the machinery operates smoothly. But once fear spreads, the hidden fragility beneath modern finance suddenly emerges. And fragility spreads fast in highly centralized systems. That is the paradox modern civilization rarely confronts. The more efficient a financial system becomes, the more catastrophic interruptions become. When trust disappears, banks can freeze withdrawals, brokerages can halt trading, governments can impose capital controls, payment networks can restrict transfers, currencies can lose purchasing power through inflation, and increasingly, digital systems allow authorities unprecedented visibility over economic behavior itself. None of this requires conspiracy, only systemic logic. When leaders believe instability threatens national survival, preserving order becomes the highest priority. Financial freedom quietly becomes secondary. That reasoning sounds rational because, in many ways, it is rational. Imagine a government watching billions of dollars leave the banking system during panic. Imagine citizens rushing simultaneously to withdraw cash, move capital abroad, or convert savings into alternative assets. Left unchecked, fear itself can accelerate collapse faster than any underlying economic weakness. So systems intervene, first gradually, then aggressively. And history shows something uncomfortable about emergency powers. They expand far faster than they contract. The modern world intensified this vulnerability through convenience. Civilizations centralize wealth into digital systems because centralized systems are faster, scalable, and efficient. But efficiency often destroys resilience. A small village storing food locally may appear primitive, yet its survive